Welcome, everybody. Thanks for clicking on the video as usual. Joe here for Dead Cat Media. And I've got a familiar guest coming at you today. We're going to do a video on the Archway blockchain, specifically Astrovault. It's part of the Cosmos ecosystem, in case you never heard of it. And last video, we did kind of a deep dive, he and I, on the mechanics of the DEX. How does it work? Most importantly, how does it make money? Why is it sustainable where most other DeFi apps are not? This time, I'm going to ask questions from the perspective of someone who would actually want to farm the DEX, a yield farmer, and we'll see where that goes. Some statements that were made last time might have been a little bit unclear, so we're going to circle back and dig a little deeper on those. And in general, we're going to talk about how the stakers of the token are affected versus the LPers, especially since the AXV token, the Astrovault token, is not a layer one. So I have here the economics lead for Astrovault, Eric. Appreciate you coming. For people that don't know Eric, he's either 26 or 52 years old, and maybe he was like one of the first people to use sunscreen even before doctors even knew about it. He thinks that Bitcoin has no max supply. He thinks that Uniswap was a failed science fair project. If he was a wrestler, he would go by Eric the Neck. He loves inflation. And as a wrestler, his finishing move would actually be a sleeper by way of reading one of his papers to his opponent. So, Eric, thanks for coming.
Oh, that's savage.
Was that good?
That was fantastic, Joe. Thank you so much for having me back, brother.
Yeah, no problem, man. And this time I think I spelled your name right, so we're going to bring it right out there and see if that works. And that's your name, right? I
That is
spelled it
my
right this
name.
time?
Spelled it right first try.
Perfect. All right. Well, I'm a teacher, so I use Grammarly, and I got some spell checkers on my browser here to help me out. You and I are connected through Astrovault, and last time we talked about the token, we talked about the mechanics of the DEX. Now we'll go into some other areas of it for people that are also holding the token. We're going to talk about yield farming. If a yield farmer is bad for the platform and whatnot, but we'll go through some yes or no questions first. Just let me know when you're ready. We'll try to zip through these as fast as possible.
Bring them on.
All right. Does this DEX actually appeal to DeFi yield farming, let's say DeFi experts who are coming in just to make money without actually having to care about the AXV token or becoming a DAO member?
Yes, it does, and it better. That is the entire goal behind building this. So yeah, you could go on, you can find APRs, and you can farm them and earn your money, take whatever risk you're willing to, and keep your capital liquid instead of locking it up for 21 plus days.
All right. Number two, can the token holders make money while the LPers are also making money?
Yes, they can, because we actually earn money from how the DEX operates.
Are the interests of the founders more closely aligned with the LPers or with the stakers? That's not a yes or no question, is it? No, it's not. Wow, what a bad job by me putting it in the wrong section. But yeah, very
Uh,
brief, and we'll dig deeper into this.
that's a great question. I
Gotcha.
I'd say the interests of the founders are most aligned with the long-term vision of Astrovault. Now, the stakers are more likely also long-term aligned. However, the LPers are the ones that are providing more value to help the long-term success rate more than the stakers are. So I'd say more technically aligned with the stakers. However, more grateful to and pragmatically aligned with the LPers.
Fair. We'll circle back to that one later on. Next question: Osmosis. Right? It's like the big decks of the Cosmos ecosystem. Can Osmosis copy this model, become a monster DeFi platform within a year using what you've thought up of and built?
They would have to scrap almost all of what they have built to compete with us. Our argument for Osmosis is that they can't really compete with us as a DEX. What they can do is they could compete with really good L1s for selling their block space, and we have seen them make that pivot. So I firmly believe that our DEX model is a much better DEX model. Our DEX is like making way more revenue and spending way less to be way more profitable as a DEX. However, as they attract a lot of utility, a lot of TVL, and a lot of users, they can monetize the L1 in a way that, like, say, Archway wants to.
Kind of an oversimplified question here. Is the AXV token a representation of equity in the DEX as a business?
Hmm.
We're both American, by the way, so we might have to edit this part out.
Yeah, that's a fantastic question. It The AXV tokens are legally set up as the beneficiaries of the DAO treasury, and the foundation that runs and manages and grows Astrovault, which is based in Panama, um, is like legally obligated to do their best to fulfill the will of the AXV token holders. So it might be more similar to equity than many utility tokens are. That being said, it still is a utility token, just with a lot more utility than most tokens have.
All right. Does it scale?
It scales really, really well.
All right. We'll take that. I'm going to make sure I buy some more later. Just kidding. Uh, um, and last yes or no question. Did Astrovault turn a profit in Q1? We know there's revenue. Did you turn a profit?
Yes.
You did. Okay. Off the top of your head, do you know how much Astrovault made in the last, week that you've been able to update those figures, whether it's last week, the week before?
I do. Top of my head, I pull it up real quick. 2 weeks ago, we made $23,000 and spent like 12,000. So made like $11,900 profit. This last week, it was only like an $9,000 profit or something. But in general, we're earning close to $30,000 a week in revenue, and then spending, and what we consider spending is emissions given out to LPs and stakers.
Okay.
That
We'll get to that as
Yeah,
we'll get to the expenses
fair
in
enough.
this
Most would make the
interview.
argument that our expenses are zero. So like, hey, we're making 20 something grand in profit, but we're trying to turn a new leaf into what, like, how a balanced budget actually works.
Right. Well, if everything's priced in your token and you're paying it out, I think that's an expense. It's just whether or not when you want to actually count it as an expense.
Mhm.
Emissions or when it's sold, right? So I get what you're saying there. Let's just quickly review the model for people that don't know about Astrovault, but it's a very unique DEX in that the liquidity pools are making some money even if no one's trading in them. Is that the most simple way to put it?
Yeah, we're the only ones whose liquidity makes money.
Okay. Um, so I'm a whale. I farm dexes. That's just what I do. I farmed Osmosis. I sent it to zero. I went to Crescent for like a day. I farmed that one to zero. Um, I see Astrovault, brand new dex. I want to come in. I'm going to supply liquidity. Can I make money on Astrovault if the protocol is making money?
Yeah, absolutely.
How?
We have higher margins than everyone else. So with the idea that most dexes only have trade fees to work with, and they have to use the trade fees to give it to LPs and to try to make some for their team and to try to give some to the token, it's just really, really low margin. What we can now offer is incentives that are higher than the trade fees that are still lower than the total revenue because we're earning trade fees plus liquidity yield. So you can go in something like I think right now on USDC Noble and Osmo, so just stables and Osmo token on Astrovault, and you can earn like 30 something percent APR. Meanwhile, we're still profiting as a DAO like hundreds of dollars a week, if not more, on that pool because we're actually earning more from that liquidity with the Osmo staking rewards and the trade fees.
All right. And I do have a question about the expenses up front here. It says last time you said that rewards are an expense. So yield farming, that's got to eat into the budget here, right? Yield farming must be a huge expense, especially for certain pools. And that gets taken out on the token, which is what the stakers are holding. Maybe they're farming it, maybe they're just holding it liquid. Can you just comment there to kind of tie that all together in a way that would make sense to someone who's new coming to the DEX?
Yeah, you're absolutely right, and this is what inflation does. It dilutes the token, it dilutes the currency, and that dilution is felt by everyone. In the United States, they call that inflation to us, but it's really just how much less the dollar is worth, like the price impacts of the dollar.
Buying power.
But yes, I very much consider as we give it out, the emissions to LPs, to stakers, to anyone to be an expense on the DAO, as we're expected to have it diluted. And we try to make sure that that expense that we're incurring is around less than ideally, or if it's more than, then at least we're growing to a point where it can be less than the revenue coming in, so that the net value, I would say, for per token is increasing over time.
Okay. So you're counting that as an expense as it's emitted, new tokens are put into circulation.
We are, yes.
So and that's a conservative way to count expenses, especially by Web3 standards.
Most people don't consider token emissions as an expense at all. It's like, oh, it's
It's
just
absolutely an
staking
expense.
rewards, and we're trying to. I've been the one going to different teams and being like, oh, well, your staking rewards are costing you this much. Like the money comes from somewhere. All you really have is the same amount of liquidity, and you're diluting the access to it. So yes, we are extremely conservative in what we consider to be expense.
And, you know, when I'm on Twitter or I'm on a Twitter space or sometimes I'm zipping through a YouTube video, I'm kind of just like using some terms kind of loosely. Value accrual is one of them. It's almost like a buzzword that might not mean as much as it once did. I want to know within reason, um, what mechanisms can actually create alignment between, let's say, the AXV holders, the yield farmers, and then you as a co-founder, like the business. What mechanisms are either in place or will be put in place to kind of create a synergy there so that value accrual is not just whoever sells first and gets out?
Yeah, great question. For the liquidity providers, it's just seeing what that APR is, what the rewards are. They want to be able to use two tokens that aren't AXV to earn AXV at a rate that is interesting and enough incentive for them to risk impermanent loss and to put capital like trusting our smart contracts. So they need
And
to see a number.
also there's a trade-off because you're foregoing staking rewards and the security of having the token on its home chain. So there's a couple things to balance in Cosmos because a lot of chains like Atom, the staking rewards are decent, right? It's still like 14%, 16%, whatever it is. So
Yeah, I mean, you can stake AXV to earn like 14% on Atom right now too. But for the LPs, they want to see something that's enticing. We usually, like one of our arguments is that we can offer APRs for liquidity providing that are usually higher than what the staking rewards are for that chain, because we're basically getting the staking rewards for the chain and trade fees on top of that. Now, it's not
right.
always quite there. Like Omniflix has 100% staking rewards right now. We're earning that on one side of it, but we also don't want anybody who hyperinflates to be able to print themselves infinite tokens. So those are more profit bearing pools for us. But we're still offering like 36% APR, whereas the next highest place in the Cosmos ecosystem is 12%. So we're paying more for liquidity than anyone else is, but we're earning more from liquidity than anyone else is. So to LPs, we're paying more than just the trade fees you get elsewhere. For token stakers and token holders, we're creating more value than we're spending, which is bringing more value to the project. And then for founders, and this is kind of new because we didn't do a private sale. We actually just recently finally started some private sale funding coming in, but we built this all completely bootstrapped. Is that we basically got enough of our early angels and outbid participants to be okay with a form of profit share to the foundation, where when we're having these weeks where like the price of our token is so low that we are running the protocol at a profit. If the price of our token went up a lot, then maybe it would be a little bit more balanced. But as the price of our token's low, and we're still earning a lot in revenue, that we can basically split the profit 50% for the team and 50% for the DAO, which helps encourage us to run, like, to keep the numbers balanced and to run the DAO as profitably as possible without us needing to sell tokens to continue getting by.
No max supply, and there's going to be inflation.
Yeah.
But there's deflation. There's a burn. Can you just give someone who's just hearing about AXV for the first time just kind of an overview? Why no max supply? Why is inflation desirable in this case? And is the burn putting a dent in it?
So nobody likes dilution. Nobody likes inflation. Oh man, my dollar's not worth what it used to be. But everybody wants what inflation pays for. So if you're like, oh, okay, we're going to keep the value of your dollar. By the way, there are no more fire stations or cops or public schools. Like, whoa, wait, let's not get extreme here. It's like, well, okay, what are you comfortable paying with, and what aren't you comfortable paying with? It is worth it to some degree to have deflation of like inflation of the dollar, decreasing purchasing price of it to get these social benefits. And at that, the inflation, the dilution that's being experienced is experienced most highly at the top. I know this isn't really how it's taught in school because like it ends up trickling down and affecting like the poor, but like that's also why the rich are investing so much is because they're trying to outpace the dilution that's happening for the dollar, which they have a lot of and is hurting them more than it's hurting others. So there are public goods we need to grow. We need liquidity. Why would liquidity come here if we're not going to spend for it? If you look at a layer one, like what happens if they just completely turn off their inflation? Are the validators going to stick around? Are they going to continue running relayers for them just out of the goodness of their heart when they're actively spending money for this chain to exist completely separately? No, they're running their own business. They want to make more for it. The chain wouldn't be secure without it. And so they're willing to spend a certain amount for this established security. And if they didn't, they wouldn't be secure and they'd completely fall apart. Similarly, for us, instead of our security, which we're able to basically rent from Archway and other chains coming forward, is we need this liquidity. We're willing to pay for this liquidity because we earn so much from it. It's like a marketing expense, basically. But we don't want to overspend. So we need to kind of walk this fine line. We've had some people say, oh, well, I can earn 100% APR just on stables on this other pool. Go do it. By all means, go do it. If you can get a better rate than you're getting on Astrovault somewhere else, go do it. But read between the lines, make sure that they're safe, make sure you're not dabbling in something else, because it means these other projects are spending a lot more than they can afford to get your capital over for a while, and that money's going to run out, and that token's going to decrease, and we're only willing to spend so much so that we don't risk capitulation of the price of the AXV token.
And I also asked earlier about Osmosis. Osmosis had really high inflation in the beginning. It looked wonderful in the bull market because people were just buying it to LP for the really high staking rewards. A few months before the UST DPEG, it started just coming off the rails. But right now, why can't Osmosis, like I know you answered this a little bit before, stake all their liquidity, use those staking rewards to just buy back and burn the excessive amount of tokens that they released as inflation over the last 2 or 3 years? Because what they're releasing now as a percent of the circulating supply is almost nothing compared to what's out there. Why can't they do that? Do you believe they'd have to rebuild everything, almost migrate their whole DEX onto a different platform?
They would have to rebuild everything that we built, and frankly, we built more. Like the amount of code that goes into our DEX is more than anybody else's. Most of what Osmosis has built, like their team is absolutely incredible, but they're primarily focused on building solid L1s and the modules and that side of things, rather than the way the DEX operates and the DeFi stuff. Most of their DeFi stuff is, for the most part, forked. It's Uniswap v3 type stuff.
Right.
They've done some cool things, but like even their super fluid staking idea isn't nearly what Astrovault has. So it sounds simple enough, like, oh, we'll just stake the liquidity. Okay, well then how do you trade for it? Like if that token's staked, how do you trade for it? It's like, oh, well, you need some kind of stable pool like we have, but then how do you liquidate it 1-to-1? And we section 6, I believe, of our first white paper, astrovault.io/white paper. I won't put Joe to sleep. That's my finishing wrestling move. But
Boring.
basically,
I
we
have it
go
here.
into the math of why staking derivatives aren't liquid and don't work. And we built a solution to fix that. That's working really, really darn well right now. But it takes all of that solution to make it work. Just plugging in Stride assets isn't going to solve it. Just doing another community pool spend to the Atom Hub to oh, well, if we just have more liquidity against Stride assets, like it mathematically does not make sense. We've said it for years. It's done nothing but prove that over and over again. That is not a solution at all. We have the solution, and they'd have to deprecate everything and rebuild what we've already built, which would be a heck of a case of humble pie. And if anything, showcase that we were the ones who found it anyways. So if they want to go to all those extents, go for it. If not, it just means that Astrovault's going to be able to pay more for liquidity because we earn more from our liquidity. And so you can LP on Osmosis for 7%, and then go out of range and experience incredibly high impermanent loss, or you can LP on Astrovault for 16% and Like, and that's still going to be the case 2 years down the road because we're earning more than 16% off of your liquidity.
None of what you just said is going to make it to the final cut of this video.
Fair.
All right. We'll get to concentrated liquidity in a sec. Last time, you said that the AXV token is needed to have stable pools. Can you just quickly comment on that for people that don't know what that is? Because it took me a while. I watched it back and then I processed. I'm like, oh, I should have asked a follow up there to explain that a little deeper.
Yeah. So people are finally asking a question, which is good. Why do all of these projects need a token? And the answer is most of them don't. That's just how they're able to raise money. As a tokenomics person, of the firm belief that that a good business doesn't need a token, but any business could be better off for having it. At least legal shenanigans aside, it can run more efficiently for having properly designed tokens. For Astrovault specifically, what Astrovault would look like without a token is if you're liquidity providing like X Atom and X Arch, you would be earning the trade fees and the Atom staking rewards and the Arch staking rewards directly to that pool as a liquidity provider. And you might be earning like 25%, and you're super happy, and
You
that's
might be
absolutely
okay.
you're right.
Yeah.
And that's great. But the issue is, what about the USDT, USDC LP? They
Okay.
aren't earning staking rewards. They're only earning trade fees, and those trade fees are zero until you have so much liquidity that's actually even worth trading. And something has to be spent before revenue can be earned. And what do we give out? And so we could siphon out some of the Atom and Arch staking rewards and give it to that pool. But all of it gets really difficult to monitor all these levers. What's a lot easier is just
Right.
creating a new token that's specifically the expense for this kind of stuff and giving it out all these different ways, and then relaying the cool things like the governance power we have in Atom and Archway and Omniflix and Jackal, and relaying all of that governance power that the LPs would have to our token holders.
Right. So the AXV token is perfect because it is accruing value either directly or indirectly from the entire business of the DEX. But now you're going to be able to pull stablecoin liquidity, attract stablecoin liquidity, I should say, that's not earning staking yield, just to make the DEX work better. Make the whole it'll make Archway work better, be honest.
Right. So right now we're earning a net profit weekly, as I mentioned, but not every single pool is earning a profit. We're spending more on some liquidity than we're earning from it. Some of our stable pools, we're operating those pools at a loss, but it lets the DEX function better. It lets the routing of the tokens work better. I come from a casino background, and the way these casinos work is every different section of the casino, valet, hotels, of the bar, like all the different sections are operating at a loss. Even the poker rooms usually run at a
Poker.
loss.
Poker always runs at a loss, yeah.
The only sections of the casino that make money are table games and slots. And it's like, how can you run so many different departments at a loss? It's like, well, by running them, you bring in more people who bring in more money, who give you an absolutely ridiculous hold on the table games and the slots. So it's worth it. You make more money by operating different facilities at a loss to bring in revenue to your revenue makers. And that works for a lot of different businesses. HRs aren't bringing in revenue for different companies, but if you factor in how much you're going to save in lawsuits, it ends up being worth it. We're trying to run this like a cohesive business.
Two more questions. What other types of pools do LPers need to know before they come farm your DEX?
So we have three denoted on the UI right now: standard, stable, and hybrid. All of them have a bit of nuance to them. Standard is just typical X times Y equals K, the very first LP pools you ever got into on Uniswap. Super easy. The price can go to infinity. It can go down to zero. We use this for most things instead of general purpose concentrated liquidity. Stable pools are swapping things at exactly even rates. We can have the trade fee schedule change a little bit, but that's how you can trade like X Atom for Atom exactly 1-to-1. You could trade USDC to USDT exactly 1-to-1. It's only meant for things that are supposed to be directly pegged to each other. Hybrid pools are actually a really, really, really big deal, a huge development on our part, where we made the most concentrated liquidity possible. That is, the entirety of the liquidity pool functions as a single limit order at a 0% margin, a 0% width. the entire pool is set up right there where you can trade like the entire amount with no slippage. Just the more you extract from the other side of the pool, you kind of have scaling trade fees. We've already seen immense success since this came out, but basically it works for assets that are like predictably priced. So if it's like a auto compounding staking derivative in a regular asset, like we know how it's going to go up, and we did the math so we can factor in like how much it should trade below its peg. And then it works for assets we don't realistically take price control of. Like no matter how much you trade on Astrovault, you're not really going to affect the price of Bitcoin. I hate to break it to myself, but that's the case. So why should we allow Bitcoin to go all the way to zero or all the way to infinity when we can instead take all of that liquidity, have it all traded at the spot price, and then users can get a really, really great trading experience without having to leave our decks, and we can get the most trade fees for the least amount of liquidity, which means that we can spend more to these LPs, but actually still earn at a much more profitable rate.
Okay, so let's just back up. The wrapped Bitcoin or the bridged Bitcoin is a good example because on small dexes, they're going out of their way to secure, bridged ETH, bridged Bitcoin, but they have such a little amount that the price is going to swing, and there might not be an easy way to arbitrage that even with Axelar and the different bridges. So you're saying that even with a little bit of liquidity on Astrovault, the Bitcoin price, no matter how big of a trade I put in, as long as it's not bigger than the whole pool, I'm able to get a stable price. Or
Yes.
are there limits to that?
The limits are you can't buy more liquidity than there is. The closer
Okay.
you get to buying up all the liquidity, the higher the trade fee is going to get. So right now we've got like 600K in the Rat Bitcoin USDC pool, and it's not split 50-50. Right now it's decently close to 50-50, but it's not. If you want to buy 50K worth of Bitcoin, you're going to be like, oh my goodness, this trade is so much cheaper and better than anywhere else. Like this is absolutely obscene. I can buy a huge amount of this pool for dirt cheap. If you want to buy 300K worth of Bitcoin, it's like that's about all there is. Like, whoa, I'm experiencing like an 80% fee at this point. Like that's ridiculous. I'm not going to do that. Like we can't have you do that. Like it's gonna be difficult for our users. So it's gonna have kind of natural limits. We wrote another long paper about this to put people to sleep. But yeah, you can't
Mm.
trade more liquidity than there is, but we can walk a fine line where you can execute really, really large trades for the size of the pool with zero price impact.
So almost like an OTC trade.
Um,
End
yeah, I'd say
result wise,
like a limit
to a
order.
point, like a limit. Okay. Okay.
Mhm.
Perfect. And then concentrated liquidity was really the last point I wanted to bring up. I was going to say, how much liquidity do you really need in certain pools before there's diminished returns? I know Osmosis, they're going to concentrated liquidity. Actually did confuse things for the end user a little bit because you have like three different pools with the same pairs, all these bridged assets, wrapped assets. You guys are still kind of new and clean. Um, just comment there because if I'm yield farming, it just looks more attractive to go to Osmosis and say, oh, this Celestia Osmo pool's 349%, but it's concentrated liquidity. What what do I do if I come over to Astrovault? A similar pool might only be 20-30%.
Yeah, so it get the APR you can, understand what it's coming from. If you could get that on Celestia, on Osmosis, it's probably because they're paying a crap ton of money for that liquidity. Like, hey, we would love for them to pay people to liquidity provide on Astrovault. Like, that would be fantastic. Osmosis has that kind of user base where people are choosing to do it. Good on them. We can't compete with everyone on everything if we want to grow sustainably. But if
So wait, so let me just ask this. So your hybrid pool is more about keeping the price as stable as possible, especially for something like Bitcoin, where you need the price to be pretty much what it says on CoinGecko for people to keep faith in the DEX, right? But concentrated liquidity looks like it's more, hey, look, we don't need that much liquidity in this pool like the last bull market, and we can still pay out these high rewards to LPers. I know that you have to manage the position and all that, but would you? I guess where do you
we don't have
compete
to
there? Do
manage
you
the position.
bother? Yeah.
We don't have to manage the position.
Okay.
That is fully automated. You don't set like, oh, this is my range. There is no range. It updates by spot price constantly. Like, so if the price of Bitcoin changed, then it changed in our pool too. It didn't take anybody trading on our pool to change it. It doesn't require any arbitrage. What we're trying to do is give our users the best trading experience and the best rates that they possibly can, while doing it in the most affordable way possible. Our number two goal is to make money, to be a decentralized business that grows. Our number one goal is user safety. Concentrated liquidity is not safe. Period. End of story. No version of concentrated liquidity is safe. Most people don't talk about it. Most people don't understand it.
Hold on, Sonny. Sonny, he's saying shut it all down. Just shut it down. Move to Astrovault. He's gonna call you.
Cool. Yeah. So it's not safe. It's kind of like put options, if anything, when you're doing the Uniswap v3 pools, which is what like Osmosis copied, where you can not just have impermanent loss anymore, but now you can have bidirectional impermanent loss, or as I call it, permanent loss. That's possible on our pools too, and we're hoping that the benefits outweigh the bad. We've been keeping really detailed monitoring of it. I've walked people through examples, but like you can have liquidity in a USDC wrapped Bitcoin pool, and the price of Bitcoin is 60K. The next week it goes down to 50K. The next week it goes back up to 60K, and now your LP position is worth 5% less. And you can be like, well, how did that happen? That's what the kind of stuff concentrated liquidity can do. At the same time, you can have it where now your liquidity position is worth 5% more. It's just probably a little bit less likely to. So there are all kinds of new risks with concentrated liquidity that just are not being discussed at all. Our team is some of the lead researchers on this. We understand it a lot. We want to do more boring papers and put you to sleep on it. But in the meantime, we know how to do it more safely, and we know why we're doing it for a rhetorical purpose of growing the business, of making more money for ourselves and our token holders.
All right. I can't wait when I have Quasar on a Twitter space soon to tell them it's not their fault. This is not your fault. Don should
Don't push
apologize.
it.
All right. One more question. One more question. All right. This is about you said a couple minutes ago you want to have this amazing trading experience. You want the best swap rates. You want as little expense to the users. And I've also heard you in the past comment about aggregators. Your plan is to have all these aggregators tap Astrovault more often than not. Those two things kind of go hand in hand, right? So there's a big cross-chain future for Astrovault in a way that Astrovault doesn't need to be like a household name to be really successful if these aggregators do what they're supposed to do, and if everything you're saying is what's going to happen in reality. Can you just comment there on the aggregators cross-chain future and Astrovault's ability to compete with just having the most precise swaps?
Absolutely. And you actually touched on this when you were asking like when is there diminishing returns on liquidity.
Mhm.
So every other DEX only has trade fees to work with. And they usually give them to LPs, and they usually give nothing to their token holders or their team, and they basically operate as a weird science fair, as you mentioned in the intro. We don't. We operate as a business. We keep track of our expenses and our revenue, because as everything else fails as businesses, we're still going to be around kicking. But we are working with trade fees and liquidity yield. The ways we can cut costs is by giving less emissions, lower an APR. The way we can raise revenue is by adding liquidity and or adding trade fees. The best way to add trade fees is to have these aggregators that get adopted into other people's websites route trades through us. They don't care what platform they use. They should be long term. They should be the best user experience for trading, better than my team could possibly deliver.
Yeah.
Um,
As
and
long as they're tapping Astrovault's pools, nobody should care either.
Exactly. So then it's up to us. What does it take for our pools to be the ones tapped? Right now, like pretty much every rat Bitcoin trade would go through us. Most Osmo trades would go through us and our hybrid pools. If we can start getting all of these trades, or at least a lot of these trades, to go through us instead of other dexes, we get the trade fees. They don't get the trade fees. So where are their diminishing returns? The diminishing returns are how much liquidity we're paying for that isn't giving us the additional trade fees,
Got
or
it.
isn't making us as much as we're paying them in the liquidity yield. But if we're just under somebody else for that trade going through, and they're getting 100% of this trade revenue, then a lot of expense is warranted to put us just over that threshold. And now we're earning an extra, I don't know, $15,000-$20,000 a week just in that pool from the trade fees that are going through from users who have no idea what Astrovault is. So we need to keep track of ourselves and our competitors. It might be worth it to have more concentration on less tokens and just be the place to trade those tokens. But we're doing analysis on this kind of stuff all the time. Nobody else is, because then they have to acknowledge that they're not a business.
All right, guys. Yield farmers, mercenary capital, Astrovault's wide open, as you've just heard from Eric. Thanks so much, man, for dropping in. Really cool to talk about these kinds of things because most people would not normally not want to go this way. And I don't know, I'm pretty happy with the way Astrovault's running. I'm sure most people that use it are as well. Great to talk to you.
Joe, thanks for having me back on, brother.